Pattern strategies and review of the course. I'm going to go through what we've covered, and it's kind of difficult to do all of this without redoing the whole course, which I can't do. So what I've done is I put together quite a number of slides to review many of the patterns. As we've gone through this course, I have focused on the individual pieces of each module to explain those. And here I'm going to combine all of them together as we go through the charts. So I'll be talking about individual pieces as well to review that, and some of them will be combined with some of the other, as I call it, thought building lessons. And after I go through all of this, I'm going to bring up the platform with the live charts, and I'm going to go through those charts in multiple time frames from a core and swing trading perspective, reviewing many of various stocks that I'll look at. It's probably the broader markets, and talk about all of these strategies together. And I'll also do that with intraday charts. The focus is different, whether it's swing and core versus intraday, but the concepts are all the same. Let's go ahead and go through this. I'm not sure how much time we'll be spending to go through all of this, but it'll be time well spent. All right, so here's the foundation for master trader technical strategies. As I said, I'm going to go through each of this piece by piece, and then we'll put it all together again. So uptrend defined as higher highs and higher lows. Minor support, the area of the prior high within an uptrend. Major support, the area of the prior low within an uptrend. So higher highs, higher lows. The high that preceded a pullback, that's your minor support. And the low that prices advanced from and then took out the prior high, that becomes our reference point of major support. And that is key as it relates to our trend analysis, since it's higher highs and higher lows, and the violation of major support ends the trend by definition. So their buyers will be at either minor support or major support. It says, however, the deeper the retracement, the higher the odds of the trend actually changing. That being said, until major support is violated, the trend is still up until that changes. A void is created by momentum moves, which is rapid price movements or a gap in time. Those voids are what we look for when we find a setup that suggests the direction of prices, and if the void is there, that then suggests pattern should follow through in a substantial way. Relative strength and weakness is just simply based on the comparisons of one instrument to another. That could be a stock versus the S&P 500 or the NASDAQ 100. Intraday, it could be a stock and or the S&P 500 versus the NYSE tick. And we'll take a look at that as we look at the live charts. These are just the acronyms that we go through. Sometimes I just label them with the short acronyms, but just a review of those again. We looked at this chart at the beginning, and I said, go through and find different setups. And this is what I'm going to do when I bring up the live charts, and we're going to do it in multiple time frames, just looking for the setups. And I'll review the different setups that we look for. And as I've mentioned it somewhere in the course, we are, by definition, price pattern traders. So we look at price patterns and we put that in combination with trends and multiple time frames and relative strength and weakness, market internals, some intermarket analysis, and that all comes together for a high probability trade. So the patterns are starting points. One of the pitfalls of being a pattern trader is seeing the pattern. Well, I guess that's initially a plus, that you can see the pattern. However, seeing the pattern, which does suggest a direction, to say, did I apply the various concepts together? Because once you see the pattern, it doesn't necessarily mean that you want to take a position. And you say, well, why not? Well, because you can have a bullish pattern develop within a downtrend so that you don't place a trade, or what I would call an impulse trade. and that's part of the psychological hurdles that we deal with. You need to become familiar with the method so that it becomes second nature. So the thought process happens instantaneously, where you see the pattern and you automatically say, did I, you don't go through the thoughts, but they just happen instantly. That's what second nature means, is that it all happens virtually without thought. But you look to the left, you look at your multiple time frames, you consider what the broader markets are doing, and so on. So as we look at this chart and say, well, we'll see a buy setup here, which is just a pullback here toward an area of minor support, and you get bottoming tail bars that moves up. And here's a perfect example of a situation where, for whatever reason, we don't have the information, but for whatever reason, this great looking pullback pattern here with these bottoming tail bars didn't go very far. And that could have happened. Maybe there was a giant volume spike, or possibly at that time this was showing relative weakness and it just began to move at that time, and then the market pulled back. We don't know. What we want to take away from this is that even great looking patterns, for whatever reason, at times, they're not going to go as far as we may have thought that they would. That's how we manage. And this is a great example of, there's no doubt we would have been stopped out with a stop under here, unless, of course, we went with half the shares and twice the stop, which we covered in the management section. And then we would have held on through this. And that, I will tell you, is easier said than done because of this choppy type of price action. Now, if you can detach yourself from this, that is part of your goal. And it's saying, well, my stop is down here. I've calculated my maximum loss in an area lower, and that could be down here, your next reference point of support. And then, sitting through this isn't easy, to be watching these kind of a pullbacks, and then as you see prices recover, and it certainly looks like they can get through here, and that would be the exact thought. If it can get through here, I'm back off to the races. And on this bar right here, this is the snake in the market, so to speak, that bites. Right here is when it's dropping and it takes out the stops. Here's our shares right there at the bottom. You got that bottom tail. If we didn't calculate the management for it, because if it was under here, we have to exit. That's the plan. Now, can you get back in on this reversal? That is a little bit of a mental hurdle, but that is the goal, to see something like this and shake off being wiggled out. And if you're not in it, it's a great setup right there. Bottoming tail and a potent reversal here, and it should go up, and you're going to be looking if there's a void. And here's a nice push up and a continuation pattern, a 180 type reversal. And if we were to condense these 2 days, we could have a bottoming tail or a money bar. I'm going to show a slide on that. But money bar setups happen after an initial move. So here was a period of consolidation, and then prices pushed up, and we have a continuation pattern. And while we didn't really talk about this, and I'll talk about that a bit as we go through the charts, but this is a measured move type of setup where you have an initial move, a quick correction and reversal, and then a move relatively equal to the first move. Don't know why it happens, but I've seen it 1,000 times over the years. And it's just a guide as to what is likely to happen as far as a target area, this measured move type of setup. There's another choppy type of reversal in a wide range bar, reversing to the downside, big bearish bar. Now, that does suggest or signal that prices should move lower. However, your major support is down here. So the trend, this pullback does not violate the trend, pulling back and, drops down and bottoming tail, which says, hey, here are buyers. Do I want to buy this bottoming tail bar here? Not with a full position size, because it's too far away from support. Can I do it? Yes, half the shares, twice the stop. There's nothing to say that in any given day that this kind of a pattern couldn't follow through to the upside. if momentum is really strong, the markets are strong, a pattern like this can follow through. So that's something that you would have to assess in that particular market environment to see, does that really make sense to do? It isn't where I can tell you that when you see this, just press the button every time. I can't. Part of what we do is gaining, as traders and investors, is gaining experience with different market environments and being able to make that decision. In any event, a move of this extent, half the shares and twice the stop, for me, would always make sense. And then here on the second turn, and I'm going to cover this pattern with you, the lower high, lower low within an uptrend, that is definitely an entry point where you would want to add the second part of your position. And as prices move up and you see momentum beginning to slow down, and over here, the distance at this point is much less high to high than it is here, high to high. So momentum is slowing down. You'd have a momentum type divergence. Indicator users would say, hey, look at my stochastic or RSI or whatever it might be, showing the bearish divergence, and then prices pulled back. You don't need any of that. What you need to do is just observe these moves, and once it makes a new high, if you get a red bar in an uptrend, you know that the momentum is slowing, and you can see the small candle bodies here, that the momentum was slowing, and then it broke down below this swing low, which is major support. So as this moved higher, and then here we have a swing low or a pivot, major support. Now, I covered pivots being a pivot bar with 3 higher lows to the left and right. This one only has 2, so you can call that a minor type of pivot. And once it moves significantly, I would call, and that's kind of a subjective term, but 3 bars up, or the distance here away from that pivot, it's created a little minor support, is definitely a reference point that I wouldn't want to see taken out. But it does not meet the definition of our trend following pivot, but our money management pivot. We would bring the stop under here. In our position and money management section, I said 2 higher lows to the left and right. After a move, I would then bring my stop under here. And we continue to do that. Stop under here. Momentum is slowing down. The next question is that you should be thinking, and that should become second nature as well, why? Why did it happen? Well, it's moved up a lot, but what's moved up a lot could move up a lot more at times. But what's to the left? Is it at an area of price resistance? And even in a higher time frame, this could be a daily chart, and on the weekly or monthly chart, this could be coming up into resistance within a downtrend. We could still play this at the appropriate time. For example, the monthly is a climactic buy, and this has had a nice move up where we follow the trend and the patterns on the daily time frame. And as this come into resistance on the higher, well, I know the expectation for momentum to slow down and the trend to reverse would be at hand. So all of this comes together as you put all of the pieces together of what we've covered in the course. So the foundational components are technical investing and trading. Price is king. Everything else is secondary. The candlestick analysis, trends, multiple time frames, support, resistance, volume, relative strength and weakness. I don't have it on here, but of course you would do that. And what's happening in the broader markets, all of this comes together to form our master trader technical strategies. And I don't care what you trade, all price movement happens because of traders, you and I and hedge funds and mutual funds and whatever is out there. It's all people trading that, and they react in the same way, whether it's greed or fear or indecision or confusion. It all is reflected in the same ways regardless of what you trade. So the basics of candles. We look for wide bars and narrow bars, and the narrow ones tell us momentum is slowing, and the big ones tell us that momentum is increasing. And it's all about, is it an igniting wide bar or is it an ending wide bar, whether it's bullish or bearish. Topping tails, sellers took control, bottoming tails, buyers took control. When we look at bottoming tails and topping tails, the next question is it also a range expansion, topping tail or bottoming tail? Because wide range bars are either igniting or ending, and bottoming tail bars are just another form of when it's a range expansion bar, a wider bar, but it turned around. So a big red bar and a climactic move to the downside that turns into a bottoming tail, which is also would be a range expansion bar, would tell us that buyers took control and the odds are extremely high that prices are going to move up. Because I referenced a climactic buy setup, the ideal scenario for me, as I look at climactics, I prefer a retest and failure or a W type of a pattern. So a pullback after an initial move up back toward this big bottoming tail bar, which could be followed by a smaller bottoming tail bar. And of course, we'd be looking at volume. All of that comes together for high odds trades. Now that climactic bottoming pattern on the daily with a monthly uptrend, for example, or into significant support, you see how we're putting all of this together? And as we do that, the multiple time frames and the patterns and the volume and such, the odds are overwhelmingly in our favor. So let's look at some of the patterns here. Don't get caught up in the exact thinking of the patterns. Uptrend patterns. These are the foundational 4 type of patterns, just pullbacks, a bullish flag. In other words, it goes up and it kind of corrects, sloping to the downside a little bit, looking for a continuation move higher. And these are just the bearish ones. Your retest and failure pattern, your W type of a pattern, or M type of a pattern, or just a base, a well-defined base. How do you define a well-developed base? You kind of eyeball it. One of the ways is to just see if it has moved up already. If it's in an uptrend, it goes sideways into a 20 MA. You could say, well, what if it goes sideways into the 10 MA? Well, generally, that would be too short of a moving average. The 20 just works better. So it's just a guide, a visual aid, and generally it works well, and that's why we use it. Oh, trend trade, pullback and reversal. And this is your basic type of trend trade. Prices have moved up, pull back a little, they exceed the high, this becomes minor support, this becomes major support, and as it pulls back into that area, this is where buyers should show up, and you look for that reversal to happen. It's like, could it form a W here? Well, absolutely. It isn't always going to pull back in this perfect way. It could come up a little bit and come back down a little bit, and once it does that, it is then created a new pivot and reference point of support that wasn't there before. As prices pull back, this is my reference point. As they complete the pullback and begin to pivot, it's created a new reference point for me to focus on. Whether it pushes up like this or it stalls and comes in, I can use this as a place where I could add to the position. It might poke under here a little bit. You'll have to see how it develops. We can look at all of these patterns, but we don't know exactly what's going to happen in the moment. And that's part of, we talk about, you have to be able to operate in a state of not knowing, meaning ultimately you don't know exactly what's going to happen, but you're okay with that. You have a method to continue the analysis. Now, as prices pushed up here, we see the range beginning to expand, wider range bars. It's getting a little far from the 20. Odds are momentum stalls. It pulls back. It could go sideways. Now, what if it went to minor support? Well, that would be okay. Ideally, it would go sideways and create new support and then go higher if it was within a void. And that's one of the things that you would look for. Is it within a void? But it could pull back into this minor support area. And ideally, ideally it doesn't pull back too deep, because the deeper the retracement, the greater the odds that it could break the trend. Counter trend trades, they're just getting extended. So you can see the distance from the 20 MA. Here it's relatively close, and then prices continue higher, where you would think, hey, this will pull back a little bit. Maybe it pulls back to minor support. I get an entry point or somewhere in between minor and major, and you get a reversal. But it continued to move higher and becomes what we call climactic, where it's getting far away from the 20. And I say, well, how far away? Can we measure it? Which is a great question. And my observations by just creating a basic indicator or gauge, whatever you want to call it, that just shows the percentage difference from that 20 MA. There are times where it works and other times where it just doesn't, and prices become more extended. You can look at the recent history of the past to see how far it moved away from the 20 MA as a guide. But different stocks and different market environments will move further away than other times, or not so, especially in a choppy market. But looking for that far distance from a 20 MA is one starting point. Now, I'll cover or look at this type of thing as far as charts go. Is what's called an ADX indicator. What it does is it measures trend strength. It isn't something to put on your chart. However, it is something that works well in scans, and this is where indicators are useful in scans. So one of the ways for looking for extended stocks, besides just a percentage difference from a moving average, which is a starting point, and of course you could say multiple bars moving up in a row, but that ADX indicator, if you tell your scanning software, as part of my criteria, I could say it's a certain percentage from the 20 MA, it's up several bars in a row, and the ADX indicator is in excess of 50. Doesn't happen too often. So you may have read in the past that trend following systems will use an ADX indicator to say prices are trending up, however they want to define it. Prices are above the 20 is above the 50 is above the 100 is above the 200, the 20 MA is sloped to the upside, and so on. And the ADX indicator is above 25 or 28. You could go with something like that, and it'll show you stocks that are trending. There's a lot of ways to use software to find stocks that are trending or markets that are trending. That being said, over the years, seeing stocks that have exceeded 50 or even 60 value of the ADX indicator have been extremely extended because the trend has been so strong. And what you see is that a pattern like this, where it's trending up strongly and pulls back very little, and that's just part of how it's calculated. So I just mentioned that as an idea in scans, and I'm going to show you what I use for scanning. Climactic patterns, it says counter trend. So here its prices are far away from the 20, and what I'm showing you here is to observe this from the point of view of this being an intraday chart. And I say, well, where is this happening? Is it into resistance? What do multiple time frames suggest? So a climactic sell setup, and I'm looking at all of these here from the long side that we've been looking at so far. You just turn them upside down, for the climactic buys. So what happens next? Well, it should pull back, but here I'm showing you the daily chart is a huge wide range bar to the upside. So I'm putting this pattern in the context of this move beginning here. So if I'm going to trade or this counter trend trade, this climactic, I'm putting it in the context of what here on the daily, and my expectation is I don't expect this to collapse sharply because the size of this bar here suggests it's just getting started. And yeah, it might pull back. So I could use this as a scalping strategy, but it isn't something where I would anticipate the end of the move on the daily time frame. Now, if it looked like this on the daily time frame and the intraday looked like this, the odds are pretty good that this is going to pull back in a significant way. It should. Now, what happens here, it could form an M top. You could say, I'm going to wait for this to pull back and make a lower high. There are choices here as how you're going to trade this. Some might just short it right under this low, and you could get a nice pullback. That is part of your trading plan for you to decide how you're going to trade a particular setup. There's a lot of different ways to do it, and part of it is, what are you comfortable with? Can you short it under here with this pattern? Sure. Since it's still in an uptrend here on this intraday time frame, half the shares, twice the stop, look to add at the appropriate time. This is what we do. So reversals after a void at resistance. Now, this type of a pattern, this is showing like, to say this was a big move on the daily chart. And here's a gap down, and prices eventually got up into that area of resistance, which could be an unfilled gap. And this is where I would look to sell short. And this is making a higher low and a higher high, but this is exactly where it should roll back over. And it's the same type of situation here as with the climactic. Do I short it right here? This would have pretty good odds of shorting it here. And what would increase the odds? If this was a topping tail bar, or topping tail bar, and maybe it moved up in a red bar here. So as prices go sideways, over time it builds up a larger area of resistance. But shorting it here is very okay, because you're doing it at the appropriate moment. And notice the 20 MA is pointed to the downside. It's in a downtrend. Now, this example is one in which it does not get up to resistance. And under those conditions, or that scenario, I wait for the M top. I don't short the first reversal, not without half the shares and twice the stop. But this type of a move, I want to see it create this resistance area, which is still within the void. And you see that here, I'm showing you the distance from the 20. It hasn't filled the gap here. And this could even be a climactic pattern to the downside that then reverses. And a climactic buy setup, I never short the first reversal, and I never short the second reversal either until it forms an M top. It has to create a new resistance area once that happens. Multiple time frame trend trade. What I'm showing you here is a higher time frame, which is still making higher highs and higher lows, and the higher time frame is pulling back. This could be a weekly. And then on the daily, which has had a move, maybe it got a little extended here, it begins to pull back, makes a lower high and a lower low. As it gets close to this support area, that's where you're looking for the reversal, where these time frames are lining up, where this should turn into a red bar transitioning into a green, and over here is where that'll happen. And that could happen, this is weekly and this is daily. This could happen over the course of 4 days, 3, 4, 5 days, whatever it might be. Could have a bottoming tail bar here. Could happen so many different ways. So as we look at this, it's to prepare based on the higher time frame uptrend, even though this has made a lower high and should be a lower low as it pulls back in here. I'm anticipating this being the lower low and then the reversal, which starts to move up. It'll probably stall here because that's resistance, but then it'll continue to move up because the higher time frame is in an uptrend. And when prices are in an uptrend, the assumption is that the trend will continue. That's part of what the things that we assume when we look at uptrends, is that they'll continue until they stop, and downtrends will continue until they stop. And they typically stop once they reach some reference point of resistance, right, in an uptrend, or it creates that resistance, and that could be in the form of an M top. It could be in the form of a head and shoulders top. It's some type of a distribution pattern, and in a downtrend, that happens in the same way, whether that's a W pattern or a head and shoulders type of a pattern. Now, stocks that have been in long-term downtrends, they typically take a lot longer to form those bottoms, whereas the tops take a shorter amount of time, especially after they get in a climactic move higher. Okay, let's move to Patterns and Strategies Part 2. So we've already looked at some of these pattern failures, but let's look at them a little bit more. Good to keep going over these examples. This is another term for these failures of failed expectations. It's all about reading what other traders and investors are thinking through pattern recognition. And one of the most powerful patterns is when the pattern fails. Now, a pattern can fail in a way where it is what I call a total failure, meaning it really shouldn't have happened. And then there are other failures where it really should happen, meaning a breakout into an area of resistance against the trend. The breakout should fail, so we're expecting that to happen. This is the better it looks, the more that are trained to identify it, the more they're going to commit to it. Now, when I say that, there are different levels of training, meaning someone could, a webinar where over the course of a half hour, an hour, someone showed them an example of some pattern. And with that limited knowledge, they are now placing trades with inappropriate, or let's just say less than full knowledge of what they're doing. And us, as being fully informed, educated investors and traders, are expecting that a breakout, if it should occur at this point in time, it will fail, and we're ready to take advantage of it. Now, those that don't use stop losses, they haven't accepted the possibility of loss, or they just ignore it. And it's powerful when these patterns fail. This is where patterns will follow through to the downside. They'll become climactic. This is a wide range bar following after a move down. And we want to take advantage of that. Now, we want to consider and accept any pattern can fail, and it can move in either direction, and we're ready for that. And we can take advantage of those opportunities, and as well as knowing when we're wrong, and we can minimize loss. So patterns can be minor types of failure, that there's a correction, as I said, that should happen, and when others are wrong, and we want to take advantage of it. And that's what master traders do. And these are some of the names of the patterns that I look at. So we always want to make sure that there's a price void, and there's the shakeout type of a pattern, which I'm going to show you what that looks like, the breakout bar failure. We've already looked at M tops and W bottoms. We have a breakout bar or breakdown bar failure. There's fewer bars there. Measured move, which I showed you in the prior section there. And they're going to form in different ways. When we look at the ideal, perfect textbook pattern, that's our starting point. But with the use of bar-by-bar analysis, which we covered in the candlestick section, you know that patterns can develop in various ways, and you're ready for that. It's the novices and even some of the so-called experts out there that point to exact patterns and say that this is the way it should happen. When it happens that way, great, but it doesn't always happen that way. And we have to be more flexible about the patterns that develop. And through the education that you now have and the use of bar-by-bar analysis, you're open and ready for any pattern that forms within the trend and in alignment with support and resistance in multiple time frames. And this is how we look at patterns and understanding them as master traders, in that how did the pattern form? What did it look like prior to completion? Now, here's a breakdown. And now I say, well, what were the expectations at that point? And what are they at the completion of this bar? And as always, we put these in the context of the trend, support, resistance, void, relative strength, relative weakness, and all of the tools that are available to us. Wide range bar moving above a highs that turn into a topping tail bar. And this is a fantastic pattern when it occurs within a downtrend at an area of resistance, and then we short it with a stop up here with our position and money management rules, and we look for prices to continue to the downside. And the opposite of that is explained when we look at these patterns. It's dependent on the time frame that you're looking at. So whether it looks like a 180 type of reversal, or whether this would look like a bottoming tail bar, it's dependent on the time frame. And this frees you from thinking of looking at too many time frames, whereas some traders would look at, as an intraday trader, where you can look at many more time frames that are next to each other. They might look at a 2-minute chart, and because they might think, well, the 2-minute chart didn't form a specific pattern that they're looking at, they'll look at the 3-minute chart or a 4-minute chart and so on. By understanding retracements and multiple time frames as explained, you don't need to look at that because you understand that different patterns mean the same thing. Whether that's a 180 reversal or a bottoming tail or a topping tail, it's the same message. It's about understanding retracements. Shakeout patterns. This is where prices had been moving to the downside, a downside shakeout. And you can see the shakeout here. And then there's a move back up again. And then it goes sideways at that resistance. That's what I call absorbing the supply. It goes sideways there, and we get that bullish price action where it refuses to go back to the downside, continuing the trend. Rather, it goes sideways and buyers step up, and the demand, the buyers, are absorbing the seller's supply, and that bullish price action signals that prices are going to move to the upside. This is a different example of an upside shakeout. This could be a 180 type reversal. I'm showing it to you as a topping tail bar. As you understand now, it can happen in different ways, and we look for a void below, and ideally this is in a downtrend, or this could be a climactic type of sell setup where this has become extended. Or we could be looking at multiple time frames where the higher time frame is multiple bars higher and extended, and this is our shorter time frame where we're taking an X-ray into what's happening on the higher time frame, and we see the upside shakeout pattern, and that gives us the signal as to when to enter and where to place our stop. Breakout bar failure. As prices move up, they begin to stall. There's a breakout, there's an inside bar, and then prices break below the low of the inside bar. Now, when these happen, you could be in a long position and it looks like it's going to go higher. You want to exit below the low of that inside bar in a scenario like that, because this 3-bar reversal is a topping tail, and that failure pattern is going to create uncertainty, and prices are going to come back in again. Whether it's a shallow pullback or a deeper one, we're not going to know, but this pattern has created uncertainty, and at that point we want to step aside. Of course, you do have the choice of selling half your shares and waiting to see what happens and then re-entering. Breakout failure, topping tail, just a smaller pattern here than the bigger pattern. But again, we're looking at these patterns and understanding that they happen in different ways, and as they do, we can take advantage of whatever the picture is. I call them pictures, they're price patterns, but they're just pictures that we understand what they're telling us and when to take action. And then the breakdown failure, that 180 reversal after a small consolidation. M tops and W bottoms. This is showing you that they can happen in different ways. And this new high is a little bit of a shock in that it took out the prior high. Now these M tops and the W bottoms, they happen after shallow reversals. In other words, the expectation is that they're continuing and they're higher, and it's actually showing strength by the shallow reversal. But once it pushes up, in this case, it fails and then comes right back in again, and this is a potent reversal. This one, you've got a little breakout bar failure type of pattern here that I've drawn out, and then there's a retest and a topping tail And this one is just retesting and turning back down again. I'm going to say it again. All of these patterns, they happen in different ways. By me showing you all of these different examples and understanding bar by bar analysis, you're ready for whatever happens. It doesn't have to happen exactly one way. That is a trap in a sense that stops traders and investors from taking advantage of what's happening because they have been trained by someone that says, oh, this is the perfect pattern, kind of the holy grail type of situation where this is the pattern that is going to always work. It doesn't always work that way. What works is understanding that different variations mean the same thing, whether it's the one here on the left or the middle one or the right one. Yes, certain ones have more shock value to them, but it's where these occur and how they form meaning. Is it climactic or is it happening in the context of a downtrend and at resistance? And W bottoms are just the opposite. Money bars or continuation bars. This is a pattern that through searching kind of discovered, or it was a discovery for me because many years ago, obviously I didn't see it, and I looked for what was basically the trend type of pullback pattern. And that worked fabulously well back in the early and mid 90s and even maybe a little into the later 90s. And as the internet evolved and information moved faster, and then the evolution of program trading, that type of pattern didn't happen as often because information moved so much faster and you didn't get as many pullbacks. So at that point, it was like, well, how do I get on board this moving train? And that was to see a correction, a minor correction, like I'm pointing out here. However, getting on board these minor corrections are going to have the greatest odds of following through without them becoming a type of shakeout after they occur at the beginning of a move. So the way I have put this together was there was a consolidation, pointing out no follow through to the downside here in reversal, and a wide range bar igniting the move higher. And then the initial move and a minor correction, and then a bottoming tail. So this bottoming tail bar, you'll notice, took out the prior bar's low and just under that bar's low. And that's exactly what we're looking for, this minor type of correction. Remember, this was a red bar prior to becoming a bottoming tail bar, and it takes out those lows, so the very short-term scalping traders get stopped out. They're scared it's going to go down at that point. Maybe they got in late and they've chased it, and they're keeping their losses small. Actually, they're doing what they're supposed to do. A very micro scalper in that soon as it gives them any reason to exit, they do, and the best ones will re-enter after it comes right back up again and starts moving higher. So that little type of a correction is our signal to get on board. And these money bars, I call them such because they have such a high probability of following through, but only from the beginning of a move. Now, this could move higher, and it could be a measured move higher and form the same type of pattern, and it might work out, but it doesn't have the same high probability odds of continuing as it does the first time. So I have shy away from the second or even the third ones and look for larger corrections. There's a 1, 2, 3, 4 type of pattern where you're getting a little bit more of a correction and then the continuation. The void concept, I just wanted to go over that again. Sharp move down, and here was the initial move, and then it created this pivot or swing high here, and that certainly could have continued lower, but a lot of times they retest that because it's short-term extended, and this is a great entry after an initial move down here. So then we call this creating resistance within the void. Wide range bar down. So we've got the initial part of the void, and then the sideways movement over time creates a larger part of the void. We've got this move to the downside, and then sideways through time creates this void up above. Now, you've got this resistance. And one of the ways of interpreting resistance and looking to the left is to think, well, how far away is it? So this movement over time, we're looking at an intraday chart. So this is a relatively large movement over time relative to the time frame that we're looking at. If we were looking at a daily chart, this might span over the course of a couple of months versus a few hours. Now, as prices move to the downside, we know that buyers up here, especially they're going to be exiting here, of course. Those that are holding on are going to be shaken out here. Maybe it would have continued lower, but then it comes back up again and they get an opportunity to sell into that initial move up. And then as prices come down, and then this is the bullish type of price action, this flag type of pattern or consolidation at this resistance area here, and prices refuse to go down. Notice the bottoming tail bar right there. That was a red bar engulfing the green bar, and it came right back up again. Bar by bar is communicating to us that buyers are stepping up on the dip, and we put that all together with what I've explained, and that tells us that this is an opportunity to go long based on this overall pattern and the void. And as always, you will consider multiple time frames. Is it in an area of support? Is this happening in an area of support? Is a higher time frame in an uptrend? So we're always putting together multiple concepts to put the odds in our favor. Let's move on to the third part, and then we will get on to some live pattern strategies in review, part 3. All right, this is going to be our last section with slides before we go to the live charts. I'm going to cover some information on moving averages, a little bit on support and resistance, using them on daily charts, intraday charts, in the conversation that we had at that time. Well, let's get going. As you know now, moving averages are not real, actual support and resistance, but can become self-fulfilling prophecies. That's why we use the ones that we do, the 20 MA, the 50 MA, and the 200 MA on the daily charts. Now, as you're looking at a weekly chart, you'll have the 20 MA on the weekly chart. Thinking of the question, well, what about the 100 MA? A lot of people use that on a daily chart. Well, if you know where the 20 MA is on the weekly, you know where the 100 MA is on the daily. That's how we use our moving averages, by knowing where moving averages are on different time frames and the trends. And we don't want to have too many moving averages on a chart. 3 on the daily chart is more than enough, and it serves the purpose of knowing what the majority of traders are following, and more importantly, hedge funds and professional traders. Some of them will use exponential moving averages, but there's no advantage of those. And I've even seen traders that put simple ones on and exponential ones on. And that's really just a search for that holy grail and the sure thing, and you just wind up with what I call a spaghetti screen doing that. Now, trend lines. If I haven't convinced you of now that they're not necessary, stop drawing them. Just look to the left. Put your horizontal lines on there for a reference point. You can even, if your software allows it, and most do, you can set an alert at those horizontal lines and forget about them. For example, you may put a horizontal line at a unfilled gap, which will project that line into the future, so it comes into your sight if prices should come down to it at that point. Of course, you can just set an audible alert at that unfilled gap, but putting the line there, as you're looking at the charts, all of a sudden that line appears, and you'll think, well, why did I put that line there? It could happen weeks or months into the future. Anyway, with the alert there, it's going to go off even if you're not looking at it. Moving averages, they speed up the analysis. They're visual aids. That's all they are. I can quickly see what the trend is. I can see if the 20 is above the 50 and above the 200 and so on, or if the moving averages are entangled within prices. We're going to take a look at that, which says, hey, stay away. So when we look at the arrangement of moving averages to price and the alignment of moving averages to each other, we come to conclusions very quickly as to what's happening on that chart. Meaning, are prices trending? Are they going sideways? Is it sloppy? And so on. We use this 20 MA as a relatively short period moving average because it follows the trend. You could use a 10 if you want. I know some traders would say, well, what about an 8? If you want to have something that follows prices that closely, go ahead and do it. You can see the arrangement of prices. If prices are moving up, for example, and each bar is a green one that starts in the area of the prior bar's close and continues higher, and prices are moving that way, then yes, a 10-period moving average would be closer to prices. However, just the observation as explained is you're going to know that prices are moving in a strong trend. So whether the moving average helps you, if it does, go ahead and use it. However, the trend is defined by swing highs and swing lows. How do we use moving averages to see the trend and location of one moving average on one time frame or another? As I'm just going to review that, we've gone over it. We calculate the number of bars in the lower time frame that makes the higher time frame. Then we multiply that by the number of the moving average in the higher time frame, and that's your moving average in the lower time frame. And there's an example. The 10 MA is the same as a 50 MA. Weekly 10 MA, same as the daily 50 MA. 5 daily bars, 1 weekly bar, 5 times 10 is the 50 MA. 60-minute 20 MA is the same as a 240 on the 5, 12 bars times 20 MA, 240. We're going to use the 200 on the 5-minute chart. And so on. 15-minute 20 MA, same as the 60 on the 5-minute. 3 bars times 20 equals 60. In the 5-minute chart, we'll use the 20, the 60, and the 200. And this way we know what's happening on all 3 time frames. What's the trend? As we look at the 5, we know what the trend is on the 5, just by looking at it, of course. The 20 MA helps speed up the analysis. We know with the 15-minute chart, is it trending? Is it up, down, or sideways? We're looking at the 60. And then the 200, which is close enough to the 240 on the 60, we know what's happening on the 60-minute chart. This is from the 5. We know what's happening on all of them. On the chart, right, we wait for a picture, right, the arrangement of candles and the alignment of these moving averages. And it says here, I'm not interested in the cross as a signal, the cross of one moving average to the other, as it is here. It doesn't tell me to act. However, once that 20 is under the 60, and these are aligned as they are, and notice they're not too far apart, it tells me that I should be looking at the short side. And of course, you're going to look to see, is there a price void? And if there is, when you see prices at the 20 or retesting a prior high, you know that's your entry point based on the picture that forms. As these moving averages are closer together in the trend, they're in agreement, volatility is contracting and it should expand. Now, as you see here, they're relatively tight together, whereas they were further apart over here, and they should move in the direction of the void in the trend. No holy grail and indicators here, just the analysis based on master trader technical strategies. Clearly, this is not what we're looking for. You see how prices are being sliced by the moving averages as they whip back and forth like this? You just stay away from this. This is a picture that you just stay away from. So as an intraday trader, we still always start with the daily time frame to see what it's telling me. And we look for, well, here's a continuation pattern right here, one that we had talked about. And one of the things I want to reinforce, and I'll do that more as we look at the charts, is that pattern set up in different ways. A chart that we looked at a little while ago had a red bar down and a green bar right back up. And I said that could be like a bottoming tail bar if we compressed it. Well, here's a different arrangement where you still had the initial move up out of the consolidation. And when we see that, we're looking for a continuation pattern. And this is just a variation of a continuation pattern. Now, when we look at the moving averages, look at how close the 20 is to the 50. So I know, without even knowing what's to the left over here, I know that prices are not extended because of the alignment or arrangement of the two moving averages to each other. And prices pulled back in between them. And I know that at that point, if it's in alignment with support, I should see a picture, price action, that suggests that prices are going to go up in the direction of the trend. And you see that's what happened. And big red bar down, didn't follow through, and prices continued to move higher. Climactic moved to the downside into an area of support. And notice it didn't even respect the 50 MA, and there was nothing to the left of it. It was just coming into a void. Big move up. Note the little new high failure up here, and as prices came back in. And we looked at a lot of examples where prices went sideways at resistance, and that was bullish and went higher. Well, here's an example where prices went sideways at support. I know it's a little bit underneath it, but we have to be flexible. It went sideways, which was bearish, and this was the coffin nail right there, that gap up and reversal. And then prices pushed down into that support area. So here's our 5-minute chart, and this is the area where it was beginning to turn up, the bottoming tail here. It moved up, and then it was going sideways. So what we're looking at here is I'm showing you that where these moving averages are on the 5-minute chart, and here's the 20 MA on the 15-minute chart. And you can see it's not exact, but that's close enough, within pennies. And you can see that the green 60 MA, same as the 20 MA, the slope and the position are going to be virtually the same as on these two time frames. And here's the 6 where prices were bottoming. You can see the bottoming tail bar on volume and the move back up. And here's the bottoming tail bar reversal. And look at the wide range bar and sideways move at the top of the wide range bar. Exactly what we want to see after a wide range bar on volume. Right? That's an igniting bar on the 60-minute chart. We had a break to the downside that failed and moved back up. And this is a downside shakeout. So all of this tells us that buyers are taking control. We see on the daily chart that it's happening in an area of support. And this consolidation here, which is building a new area of support or creating it, provides us with an intraday type of a trade. Now it's against this move on the daily chart, so my expectation is that there's going to be sellers up here looking to sell and short it or get out of longs. But as an intraday trader, this is a pattern that I can take advantage of. There's enough alignment here between all of these time frames for me to take this as an intraday trader. Here's another example on the daily time frame. And I say weekly are coming together because the 50 MA tells me what's happening on the weekly time frame. So as this was beginning to flatten out and the 20 is rolling over, and we can see the rounding top here, or the head and shoulders type of a top, and this has to break down through this area, and this provides me my bias, and there's a void down below. And here is that daily chart and the void, and here's what it looked like on the intraday time frame. So once I get this picture intraday, the alignment of my moving averages, and I've got a base here, and we've got this little push up between the moving averages that come right back in again. All right, there's my setup. And I could have shorted it here, I may have shorted it here, and had to wait all of that time. Sometimes you do have to wait. So once we enter, we're in management mode. We're following the trend of pivots as they form, and sometimes it just takes time. And this is a situation where it's possible that longs were hoping that it was going to move up. Why? Nothing on the chart would explain that to us, but that's the market. People have different reasons for doing what they do. And at this point, as you get to the latter part of the day, they gave up hope and prices fell. And here is an example from the long side, not showing you what happened on the daily time frame. However, on the intraday, you can see the alignment of moving averages, and looking at what's happened here bar by bar, and you can see the gap down that was bought, the bottoming tail, the consolidation. It's into the gap fill, acting bullishly, and you never want to short into a gap fill that starts with a wide range bar up. Historically, it just doesn't work. You can see the volume here, the buyers that stepped up on the gap down. And I would assume that the daily chart was moving up and bullish in some way over the last few days, because these moving averages are flat. The 20 is above the 60 is above the 200, and there's a distance between them. And then as prices moved up, it created this consolidation and created support, a wide range bar, and in all likelihood ending the move at that time. This wide range bar after multiple bars moving in one direction suggests at least a stall in the momentum, and then prices pulled back. You look to the left, it's into support. Time of day isn't the best time of day to be entering, but if you did, you really had little reason or no reason to get out. And as it moved up into resistance, you know that there's going to be sellers there. And here was the retest later in the day, and the 15-minute was rising. Here's the 20 on the 15, retest of support, buyers stepped up. And at that point, you're probably saying, well, what about this resistance, Greg? Yes, it's going to have to get through that, but this is a bullish alignment of moving averages, and this high was taken care of by absorbing the supply here, and then the retest. Another way of looking at this is resistance within an uptrend gets less respect than resistance in a downtrend, because trends continue, and pullbacks from prior highs, the assumption is that buyers are going to be able to push up above it, and the demand, because of the uptrend, is going to overcome that resistance. Right? So before you trade the 5, you would have defined your bias from the daily, and that analysis of trend, support, resistance, void, and price pattern. There's just another example. Here's a move up, and once you have this alignment where they're trending higher, you're looking for buy setups. And here's in this area right here, we could have had a situation where we went down to a smaller time frame, but you really don't have to. I'm just pointing that out. But as prices are trending up, you're looking for pullbacks into minor support, looking for red bars, and here a big red one being ignored, and then a retest here. It's telling me that the 15-minute, the rising 20 MA on the 15. Right? This is the 60 on the 5, but this is pulling back to a rising 20 MA on the 15-minute chart, and this is in an area of support. Buyers should step up there. That's the assumption. And then as prices pushed up, this consolidation is bullish price action, absorbing that supply. This move down on the 15-minute chart would look just like a pullback within an uptrend that was buyable. So you can look at the 15-minute, if that picture helps you, but as you study this more and more, you'll be able to look at the 5 and determine that prices are at a point where they should turn around, and then look for a confirming price pattern on the 5. And that would be right here, wide range bar up, and this little consolidation with an entry here. And you could have done a add and reduce type of trade here, or half the shares and twice the stop, adding at this point where you had further confirmation based on the price action. So multiple time frame alignment absolutely is going to put the odds in our favor, and the way we use it with moving averages helps us to see what's happening in multiple time frames by looking at one. As using this intraday, you're not going to catch tops and bottoms. It's not meant for that. It's meant for where prices are moving up already and you have a void, and prices should continue in the direction of the trend. Right? Just as we're looking to get the meat in the middle, the best part of the trade where there's less shakeouts, and prices should continue as we believe that they should. Master Trader Technical Strategies. It's not a sure thing, but at this point in the class, I'm sure you're thinking that it is, because it overwhelmingly puts the odds in your favor. And that's great. That's what we want. But we always have a stop loss. Anything can happen. And that's professional trading. These patterns, they help in many different ways, and I've given you the tools to understand how to utilize them. As I said, it's going to put the odds in your favor. Think about, what are your objectives? Long-term, investments in retirement, swing trading, day trading. Keep it in perspective. The concepts are the same. As we interpret support, resistance, and trends, it's the same. But the key is multiple time frames and money and position management. Whatever your tradable instrument is, stocks, futures, commodities, forex, makes no difference. People that are trading them, the patterns are exactly the same. They follow trends, there's voids, everything that we've talked about. This is, there is no best trading vehicle. They all can fall out of favor and into favor. There are times where stocks will be choppy and erratic, and well, if you like forex, fine. You know, they'll be trending. However, you can trade futures, the currencies, which you can bid and ask. Whereas forex, you have to take the offer, and that's how they get paid because of the spread. With futures, which if you're trading currency futures, the most liquid, of course, is the euro, but you can trade the yen and the British pound and the Canadian dollar and the Australian dollar. You can trade all of those, and you can bid and you can offer, and they follow the same trends. So the strategies that you learn, they're universal to everything. There's no holy grail. There's no perfect time frame. There's no perfect instrument to trade. You have the tools to do this successfully. Now it's your job to apply them. Let's go and review the charts, and which will help with internalizing everything that you've learned, because repetition is what you need to do to internalize this and make it second nature. All right, let's continue. Okay, master traders, let's go through some charts. And I'm going to start out first with going through charts, looking at them from a longer term perspective, basically for core and swing trading. And what I have set up here is multiple time frames. I've got the daily time frame, the weekly time frame, the monthly time frame. And underneath here, when I find something of interest, maybe that we would want to take a little bit of a tighter look at, I would look at the 60-minute time frame. But we want to start with the higher time frames first. And since I have the NASDAQ 100 index stocks here, and I've got that sorted by volume, 10-day moving average of volume, which you can see here on the end right. This is just the daily volume. This is the percent change since the open, I believe. And then this column is change from open and change from yesterday's close. And what that tells me, if I can see two columns that are green, meaning it opened higher from the prior day and it's still above the opening price, well, that's a positive, and I'd want to look at that, especially from an intraday trading point of view, to see what opened strong and what stayed strong, versus we might find something that opened strong, and I'm looking down here, I don't see anything, but what had opened strong and may not be strong anymore, meaning it's under its opening price, or vice versa, what opened weak and then is above its opening price. And right now, and we'll scroll down through this, maybe we'll find something else that changed from its open. So far, everything I see is green and green. So as I go through this, we're going to look at whatever the symbol is in multiple time frames. And as I'm looking at the cues here on the daily time frame, in the weekly time frame, I'm also comparing relative strength and or relative weakness. So the markets have been in an uptrend for a while here, quite some time, if we go from a longer term perspective. And other than the corrections, very long time, because it bottomed there in 2009, as you can see. But our trend following would have kept us in on the weekly time frame for a long time. And this was a big drop and a whip around, and would have reevaluated over time and used our market internals, which I'll take a look at with you. But right now, they're in an uptrend. We're coming into the end of 2017, and this is the 24th of October, as I'm recording this, the day after Thanksgiving, and the markets are mildly up. And the stocks are up here a little bit. So let's go through them and see what things are looking like here. So here's Cisco, which is perked up, had a good week a couple of weeks ago. Took out this resistance area. It's been an uptrend for a few years here. Quite a bit of a choppy uptrend, but you can see from where it was, it has more than doubled, and it's moving up. And we always want to look at, well, does it have the void? And it does. So what do we do here? What's how our interpretation is that it has open air. It's got a void here because of the collapse that occurred back in 2000. And what we will want to do is, just like this, I will put a horizontal line here and one here. And now those are my reference points, buy to support and resistance. And we can put that and actually do this. Duplicate on all Cisco charts. And now I have those reference points there, and I could even set alerts at those reference points. Now, with this gap up that we see in Cisco, it came out of a base. So the ideal scenario, even though this is up multiple months in a row, we do have a wider range bar here where it took that out. And we look inside of this area here, we've got a relatively long consolidation over a couple of months. What that tells us is that it should not come down and fill this gap. What would cause it to come down here and fill the gap and things still be okay? Well, if the markets went through a correction here where they topped out, and that could happen at any time. We're going to look at the internals to see what they're telling us. But if that was to happen, strong stocks like this that have a void above, they'll typically will correct, and we would then measure. We would look at this daily chart of the Qs and the daily chart of Cisco, and we would compare the correction. And we would say, well, if the Qs had a correction and they came down even to the area of this low down here, where would Cisco be in relation to the correction in the broader markets? And we'd say, well, was it showing relative strength or relative weakness? Was it able to hold unfilling this gap? And we would look at a pattern to see at that time if that's of interest to us. Right now, it's of no interest to take action in the moment. It's gapped up unless we were going to aggressively enter this, whereas, the markets were taking off, and then the markets are up 3 days in a row here. So I'm not interested even in aggressive entry on a pattern like this, meaning a move above here. If this was a larger bottoming tail, maybe, but that would be a swing or scalp, daily scalp, maybe 2 to 3 day trade, which is type of a swing trade. But right now, this is not really what I'm looking for, to some type of action in the moment. Micron Technology, it's had a phenomenal run. It's a little extended here, bottom there at the end of 2016, and it's moved up tremendous amount, and it has room to go higher. At this point, it needs some type of a correction, and it could be a minor correction, could be over several days. One of the things, the 20 could catch up, which would give us a measure of a correction happening, and that could be sideways. But right now, I can't do anything. Over here, this would be the great place to have been able to partake in a move. And this is the ideal type of situation that we're looking for. 2 bottoming tail bars near the 20 MA, which is in alignment with minor support. At this point, it's run too far. So there's nothing that we can do but continue to search. Now, Intel is interesting, because another monthly chart that has room to go higher, and it has broken out of a range, broken out of this consolidation and this huge bottom over the course of several years, and it's correcting here. And while it's under the 20 MA, that's very okay. This is just a subjective line that we decide to use. Where's support? Well, we've got an unfilled gap here, and we've got the bottom of the unfilled gap. So anywhere in between here would just be fine. And we'd look for maybe a nice little W type of a bottom. There's some support right here where these bars are overlapping each other. So we don't have anything here, but we do have a stock that is of interest to us because of the breakout on the monthly. It's a little extended on the weekly. It's correcting on the daily, and it needs to pull back a bit. So we need to keep this on our interest list and come back to it day after day and continue to monitor it. And we can set alerts. Then we can set an alert down here. Time, there we go. And my alert is set. And what we're looking at here is sorted by 10-day average volume. So it's going to be the type of stocks that you very well known to you, I'm sure. And here's Apple. And this is actually one that we put on a bullish options trade on this day. I had an alert set. I was correcting, and I thought it might come down to here or even break under the low here a little bit, which would set up an entry. Rather, it gapped up that day, and it looked like, I'll tell you about what it looked like when I saw it. I'll just put a line, maybe like that. It was a small green bar under that little line that I drew, and that's when we put the alert out. Now it's coming into resistance, and we're raising the stop, but it looks good, and the markets are continuing to move up. The monthly looks great. You got a red bar ignored here. You got a red bar ignored on the weekly here, and this is a Friday that, as I'm recording this, and this pattern says that it's going to continue to move higher, although the expectation is that it'll stall at this prior high. It's in an uptrend, so the expectation is that it gets above it, but you can see here it's stalled at the moment at that high. And let's take a look at the hourly, and you can see just the day is going nowhere here at resistance, but it's holding up very nicely, as it should. JD, right, let's expand this a little bit here. This is a pretty sloppy stock. The monthly looks good. There's a topping tail on the monthly there. Got a little head and shoulders type of a top that it's recovered from. Note the breakdown failure. So this could be of some interest if this begins to tighten up, and you can see the moving averages are beginning to tighten up here. The 20 is above, or I should say below the 50, and they're coming together, which tells us the volatility is contracting. So what do we want to do here? Well, I don't want to watch it, so I'm just going to set an alert up above those prices, and if my alert goes off, I'm going to be interested, and I'm really not interested in this on the downside, although as I'm looking at the chart, I'm thinking, this could turn into a measured move to the downside, and it could come down here, especially if the market did start to pull back. So I'm just going to set an alert down below here, and I'm going to forget about it. I don't know. I'll let the computer monitor it. Whichever way it goes, then I'll make a decision. CMCSK, it's correcting lower. On the monthly, it's coming down closer to some support. It's rather sloppy. I'm not interested. Microsoft, wide range bar up on the monthly after a run. Suggests that the move is exhausted. Wide range bar on the weekly. And that's, the gap up here on the weekly, it creates a bar. It doesn't create the gap. So right now, it's trying to create support. I don't know what this is going to do. It's just consolidating. It's held up relatively well with that topping tail that formed after the gap up. Well, the markets are strong, so I'll stay away. Siri, choppy, low price stock, I'll stay away. QCOM came back, had a big correction here. It's up against resistance, wide range bar on the monthly. It's up there near that resistance there. Nothing I can do with it here. Went sideways actually, rather than a bullish type of a flag, which would have been possibly something like this, a downward sloping and then maybe a bottoming tail bar. That would have been a great type of play, and this is kind of just churning its way higher. So up at resistance, so nothing to do there. AMAT, a lot of extended stocks, especially in the technology sector. Topping tail on the weekly, which is this reversal. So nothing to do. It's strong. Got a giant red bar being ignored here. It's holding up rather well. We could come back to it, but nothing to do right now. 20th Century Fox, gap up, holding, monthly consolidation. There's no entry point right here. Gap up could have been on earnings. And at this time we were at the end of earnings. I don't know what that reported, but nothing to do. NVIDIA, been a giant winner over the last couple of years. And look at that monthly chart, straight up. And look at this consolidation on the monthly, and then the next wide range bar igniting, and again, it just never pulled back on the monthly. That's just institutions falling over themselves to get in. But when you see this type of a chart where it's moving like this, this is where you move down to lower time frames, and you look for patterns like this on the weekly, where it's pulling back and creating a swing low, this pivot here, and the retest and reversal, and you're getting in on the next move, right? And here it's off to the races again. And on the daily chart, some gaps. There's going to be volatility and uncertainty in a stock that's moved up as much as this. We have to expect some selling is going on here by institutions. However, as we follow the trend, we mark off pivots. And here's 3 higher lows. There's 3 higher lows. Now think, why would I not want to use this pivot as my reference point of major support? Think about what the definition of major support is and what has to happen for us to use that as a reference point. Right now, this is our reference point of major support when it made a new high. And then it pulled back and it pivoted. So if we were long by this bar here, we would have used this for a trail stop, if you remember the rule. That from a position management point of view, we're going to require 2 bars to the left and right to bring our stop up. However, for trend following on the trend, we're going to require 3, and major support requires a new high, and then this would be major support within the trend. That is being done in multiple time frames. And what's interesting on here and confirms the strength of the move that's happening in NVIDIA, where is the major support on the weekly time frame or the monthly? What you see on the monthly, there isn't any. We can use this base, but there's no pivots. And when you see no pivots within a trend, the message is it's incredibly strong because there's no corrections. Buyers just keep coming. Now, so where do we have a swing low with 3 higher lows to the left and the right? Well, we don't have one here. This is actually a continuation type of a pattern. We don't have one here. So we have one here. We have 3 higher lows to the left, 3 higher lows to the right. So that is our major support pivot on the weekly time frame. Now, this high is something that we could use as a reference point, since it is at least a topping tail, and there's 2 to the right and multiple to the left, whereas prices came back. And I'm sure if we were to zero down, we would see that this bottoming tail bar here, which is in alignment with that, and this little overlap of those opens and closes is where the buyer stepped up there. And well, let's just take a quick look at that, which we can do. And I'm looking for my data window. And this happened on October 23rd. Well, let's do something here to scales and cursor. Always visible. Cursor labels visible. We're looking for the same area. So that's October 23rd, where prices pulled back on the weekly time frame, which would have been this little pullback right here on the 25th. Right, so there, right in here is where that was. And what you need to look at, we don't have a great correction there, but this is what you'd look at as to why this turned right there. There's the reference point directly to the left. So when prices stalled here, and here is the concept behind minor support being subjective as a reference point and what is directly to the left. So when we look at the weekly time frame and we see that high up there and we say, well, there's minor support. Well, is that really what stalled prices on that bottoming tail bar? Most of the time it isn't, but we need to take an x-ray into a smaller time frame to see what it really is. And when we're looking at this daily time frame here, it is this stall in the move up at this area, which is right here in that area. It's stalled here, and then on the daily time frame, this pullback is reacting to here, which is what's directly to the left, and then you get the breakout and the continuation move up in NVIDIA. So at this point, NVIDIA could be headed for another breakout, which would then make this major support. We'd have to wait and watch and see. Continue. Facebook having a nice move. Here's a choppy consolidation, downward chop, bull flag into the rising 20, wide range bar up. Weekly is in an uptrend. Monthly obviously is in an uptrend, been so for a long time, and it continues to move up. New all-time highs, nothing to stop it from going higher. Looks fantastic. I'm going to go through these a little quicker because this recording is going a little long, and I'll probably just start another one. Viacom could be interesting for 2018. It's been correcting all of 2017, and notice the bottoming tail on the weekly and the slowing momentum on the monthly, and it's not quite down to that major support point yet. But that big reversal here could be something of interest where it's turning around. We'll have to see, come back to it. PayPal's been a huge winner this year. That and Square was doing nothing or chopping around for a long time, and things came together in 2017. Wide range bar igniting, consolidation, up, 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 no pivots, pullbacks, monthly straight up, is climactic, even ignored this wide range bar. Looks like it's headed to 100, but you have to just continue to monitor what's happening and mark off major support. Here's an unfilled gap, and you just continue to monitor, and the assumption is that the trend will continue higher until it fails. And until that happens, you can say it's extended, and extended has become more extended and more extended. And of course, you can look at the hourly time frame, which is what I'm showing you here now. And now you have a new reference point of major support, at least on the hourly time frame, which is that bottoming tail bar on the daily. And so far, the trend continues to be up on the hourly time frame. Tesla, which was being loved at the beginning of 2017, has been correcting. And you can see on the weekly, it has rolled over and violated support. And so far, it's just hanging on by its fingernails, as I like to say sometimes. Whether it's going to be able to get back above the ledge or whether it's continued to drop, we don't know yet. But the daily is just holding up here. Clearly, it's showing relative weakness to the broader markets. You can see the Q's going up here, and this is just hanging out. And then if the markets got weak, this probably drops. Those buyers would give it up as that selling pressure came in. However, we have an uptrend on the monthly time frame. So from a very long-term perspective, if Tesla was to come down here, 250 to 280, and now we start to see the pattern start developing on the monthly time frame, possibly a W type of pattern or huge volume. That's how we start putting it all together, where these stocks, which were being loved at one point and going through corrections, but in the higher time frames are still looking just fine. You wait for them to come down to the optimal reference point where buyers should step up. Notice the consolidation right there. And then we wait for a pattern to set up on the daily time frame. We're taking the X-ray, right, as red bars come down here, possibly, And then over here, we'll go down to where it would be. All right, so let's say, just say 250 to 280, and look at what we have here. And I like it when it comes together with a reference point. So somewhere in here is where we would start looking for a daily pattern to set up, a bullish pattern to set up based on our monthly being in an uptrend. And notice the big base that occurred over a course of several years, and then the breakout, and now it's correcting, and now we look for a bullish pattern to happen here. So we need to keep an eye on Tesla in 2018 and put that on our go-to list. And of course, what we should do, right? So we don't know that it's going to come down there, of course. It could recover, but that makes sense from multiple time frames that if it did. So I'm going to set an alert at the top part of that area, and I'm going to wait to see what happens. All right, let's look at a few more, and then I'm going to cut off this recording, and we'll start another one to look at something else. eBay. Uptrend at support here. Nothing to do at the moment. Starbucks got clobbered earlier in the year. It's recovered here. It's a little chopping around here, but it looks like it might be able to come up. But see, a pattern like this, the expectation is it's not going to do something in a big way. So, as we look at patterns, it creates expectations as to whether the probabilities are for significant moves or relatively minor type of moves. So we've seen a recovery here in Starbucks. You can see on the daily time frame this gap and reversal and this bullish consolidation. But on the monthly time frame, it's had a tremendous run from 2009, and this just looks to me like it's in for a long period of correction, of consolidating those gains. So there's probably nothing wrong with Starbucks from a very long-term point of view, but it's all about where did you own it from. So if you owned it from 10 and 20 bucks and you're going to sit with this for the next 9 months or who knows how long where it's doing absolutely nothing, well, you're probably okay with that. However, as far as a new entry at this point in time, there's probably going to be better things that we could enter on that'll pay us much better than Starbucks will over the course of the following, months or even year, based on where this is moved. And we could scroll down to the bottom of the list of, this is sorted by volume, but we could look at other scans. I will look at other scans with you from a longer term perspective as to what's moving or what has not moved. I mean, most things have moved. I'm not interested in that. Win is just doing great, and I think it can go higher. And my point here is looking at these with you is to reinforce what you've learned and show you the patterns from a longer term perspective. Google continues to move up. Nothing's stopping it. It's through 1,000. And it's just chopping around here on the daily time frame. But trends say it'll continue to go up. ADSK continues in an uptrend. Now, this is rather sloppy. It's in an uptrend on the monthly time frame, kind of like the weekly as it's pulled back here. The highs and lows are relatively close together. And you can see the daily here holding this prior low. So we really don't have any void. What I would like to see is JBHT, as it comes up into here, spend some time there consolidating. Even if it was to come down here and retest this a little bit, it needs more work. So when you see this type of volatility increasing and this whippy type of price action, we need to see that tighten up, because when it tightens up, that's what tells us that prices are getting ready to move again. when that volatility contracts. And look at the moving averages here, how they're intersecting prices. That was one of the visual aids that I explained, that when you see the moving averages intersecting the middle of prices, we want to stay away. There's really nothing to do there. But we look at the longer term charts and we see that everything's okay. So a longer period of consolidation here would be just fine. All right, guys, I'm going to cut off this recording and we're going to look at a few other things. Okay, master traders, I'm going to go through a few intraday charts here. I'm starting with one here that is interesting in multiple time frames, because we have one here where it is definitely gotten climactic and far away from the 20 MA on the daily chart, which makes it interesting for intraday shorts. However, the 60-minute chart is still an uptrend, and it is at a point where it could turn over based on the 60-minute here, because we are getting a retest of a gap up and we got a reversal. So I'm going to be watching this one for the next day to see if it actually does break. And it's still in an uptrend. It's not even climactic on the 60. And you can see the 5 minutes been going sideways here, and we don't have alignment of our moving averages to suggest a short either. So we have a bias where the daily is extended. It's likely to pull back. However, the intraday time frames are not aligned yet. And what I have on this screen here is to watch the spiders and the Qs during the trading day for relative strength and relative weakness. This example, one in which what's extended obviously can become more extended, while is really far from the 20 MA and likely to pull back. It did come out of quite a long base here on the daily chart. So that initial move was the beginning, or igniting a move. So at this point, yes, it's no doubt it's extended, and this one you can see definitely is climactic on the hourly, but the 5 minute is still in an uptrend. So it goes on our watch list. Possibly a gap up tomorrow could set it up for at least a short-term pullback for intraday shorting opportunities. So in the last two examples, we have scenarios that provide us with a bias. However, we do not have alignment yet of multiple time frames, especially in the one that we want to trade in, and in this case, intraday trading opportunities. A prime key to successful trading, regardless of whether it's core trading, swing trading, or intraday trading, is alignment of multiple time frames. And there's no trades taken until the time frame that we are going to place the trade in and manage is in alignment with our bias from higher time frames. I've picked this stock to make the point of a daily time frame does not have to be in alignment within the trends for us to trade intraday, meaning we can do counter trend trades. Typically, we look for climactic type of patterns. However, a bottoming pattern is one in which we could find a setup on the daily time frame. And while we may not want to trade it on the daily time frame, and in this case, this particular stock, Snap, I don't want to trade it on the daily time frame because it's broken down, and this may be an end to this move. Look at the volume here. However, from an intraday trading point of view, it could set up. We have a consolidation here. Notice the wide range bar, the consolidation at the top of the wide range bar. It's going sideways at resistance, so there's bullish price action here intraday. The daily time frame, as I said, is in a downtrend. The 20 is under the 50, and it's broken down here. That gap in volume is suggestive of possibly the end of this move down. And I'll show you the rest of the daily chart in a second. Now, if this can get above this area here, well, then that opens up the possibility of prices moving higher on the 5 minute. And here's the void. Right? And so we have alignment of our moving averages on the 5-minute. We've got this consolidation, right, is the same as what was here. And moving above this area, with the possibility of moving possibly to 14 or 1350, it gives us an opportunity here to trade this intraday, even though the daily time frame is not in alignment. We're not interested in trading this from the long side. So this was an IPO back here in March, and it's been in a downtrend, and it tried to stabilize, and it broke down again. So as it's retesting the area of this prior low and buyers are beginning to step up, there is that possibility that it could move higher. And if it can clear that resistance, we could then trade it from an intraday trading point of view and then be done with it after we get our profit. WFC is just coming into alignment. We have on the daily time frame a head and shoulders top. It hasn't confirmed yet by breaking to the downside yet. However, as I look at this, I see this green bar being ignored. We have a bearish reversal here. The last day was a consolidation day, and the hourly time frame has been building up or creating a resistance area. It does have to break down, and we don't have a huge void below. We do have this swing low, which will come into play. However, from an intraday trading point of view, there is a short-term opportunity to the downside, and possibly there could be a big one if this becomes even more bearish and breaks below here. So we have the beginning of a move. It's retesting the 200. It's under the 50. The 20 is starting to roll over. And while there isn't a big void here, it looks like what could be the start of a move here, breaking down. And it probably would be somewhat choppy until it clears this area, but definitely one for the watch list to see how it plays out. I want to show you on Apple here, and this is the most recent day here. But what happened on this pullback right here on the prior day was the bottom of this hourly bar right here. You can see how this lines up. You can see the orange markers there on the 5-minute chart. So what I want to show you here is the wide range bar up and this little pullback. It's the bottoming action here on the 60-minute. Wide range bar up in this pullback, and this turn right here, this pullback into the gap fill, and this base, right, the same area right there, this little 3-bar reversal is this area right over here. And that pullback into the gap fill, into support with the bottoming tail bar is in alignment with the 60-minute chart, and clearly the Apple here is in an uptrend and pushing up toward new all-time highs. So we have alignment of multiple time frames, and the bottom of this tail is right here. We can take a look at the 15-minute, the 24-hour chart. That would be right over here on this reversal. And again, the 24-hour chart is for gaps in the morning, where the 24-hour chart can be a help to us if there's enough volume. And I just want to change this to a time frame where I'm eliminating that for this discussion right here. So there was the pullback into this nice little consolidation and this move up, and I'm showing here how the turning point, the slowing in momentum, and this turning point resulted in this move higher. And so why would you want to buy down here in light of this topping tail? Well, it's because the whole bigger picture is bullish. So that's where you're gaining your bias. And at those times, you can say, well, I'm going to ignore this topping tail. It did pull back, but everything else, which is more powerful than that piece of information, suggests that buying at this point should result in a move up. And you're going to put a stop down here. And of course, you always have the option of half the shares and twice the stop.